S&P first higher high in a week. Should we be excited? Yes and no. There's a lot of developments between CPI. There's one major development no one's really talking about. We're going to spend some time on that. It's really important, and we need to go through what sectors are actually rallying here and which ones are falling apart. There's a lot to cover, so we're just going to jump right into it. Everyone saw the higher high, the gap up, and the flip and the push. What we need to do is just start by looking under the hood. So to start with, what we're going to do is just look at 11 sectors, 11 major sectors. I actually broke it down to 14, put some more in here so that we can see. But let's just start with what happens. We go to there in the beginning of the day and we just drop the zero line, which is the yellow line. And you can see that XLRE REITs are just ripping. And it's pretty obvious as to why, and we're going to go through this. But you shouldn't be surprised by that. XLK actually bounced. And it's not the names that you think are lifting it. XLY, consumer discretionary, getting a little better. Utilities, you're seeing some movement across the board. I think what's important is if you look at the line, what's underneath of it? Gold, regionals, which we're going to address, financials we're going to address, and oil is under. So we have oil underneath everything on the zero line. Financials and gold are underneath. Everything else had a positive day. We're going to talk about why that is. Now, the number one thing no one is talking about is what the Bank of Japan is doing. And it's really important to get this. I'm going to show you why. Now, in front of you is the NASDAQ NQ, and you can see the highs, the lows, the highs. And what we're going to do is just mark it off, and you're going to want to just pay attention to this. It might be something that you might want to watch once or twice just to get it. But here we are in July, and we can see that high. That is CPI month over month negative. This is roughly when right in here, I thought I locked that on. This is roughly right in here when Japan decided to do something. We have the fall out into this. Obviously, when panic starts, when it really happens, and then we shake out when they start unwinding the trade. But it all starts with that CPI negative print. It's really important to get that. But these moves are all based upon not just us, but what Bank of Japan is either saying or Bank of Japan is doing. Now, today, they have come out and said what? They are not going to do anything. We're going to explain why this is important, but the thing that you could actually use to measure this is just go US dollar, JPY, and take a look at it. And what you will see is that that will actually mimic exactly what is going on. To the T, it will mimic the exact move of this. And it's really important to get, and I'm going to explain this so that there's no question about it, and you can just follow along with it. But you want to watch what that's doing because it's literally whatever that does is going to be the inverse of this. So you'll hear the words carry trade a lot. We're going to explain it in 10 seconds. So what they do with a carry trade is they sell something that is cheaper and they buy something that is more expensive. So in this case, they're selling the yen, right? So the yen's here and they're selling that. They're taking the money they get from selling something they don't own and they're buying something they want to own, the dollar. Now, why would you want to do that? Because our dollar is stronger than the yen because we're getting more yield here on the dollar than we're getting on the yen, okay? They then take those dollars and they will buy things. Primarily, they will buy treasuries and they will get a yield. The spread between these, and then they lever it up 4-to-1 or 8-to-1, and then they get that, and then that is their profit. The difference between these and then this leverage is their profit. When the yen goes up in value and the dollar drops in value, the spread between this gets less, the ability to margin gets less. Therefore, they have to unwind the trades. When they unwind it, not only do they sell treasuries, if they decide in their infinite wisdom to buy tech stocks with it, that's what you're going to get. Okay, so they're going to have to unwind. This is why you're seeing the NASDAQ come underweight. One of the things that we were not expecting was the Bank of Japan to come out and state, we are not looking at raising rates again until January or February. This has been a real issue for the NASDAQ. A matter of fact, it's one of the reasons why the NASDAQ, in my opinion, broke the 55-day moving average. Now, whether you look at it here and you see this declining average, this is why it's so important and why I preach the stool over and over again. And the reason for it is you have the macro, which tells you what the heck is going on. And then the fundamentals, who's going to be affected by what's going on, right? So if you're going to unwind, then those trades are going to be hit. And then, of course, you have the technicals. But think about it. If you know that they have to unwind more, you know who's going to be affected by it, the NASDAQ. And all you have to do is watch the technicals. But if you know they're not going to unwind all of a sudden, let's just finish the stool up here. But if you know they're not going to unwind, then all of a sudden, all the technicals that move this way, they might shift. Right? So the tail does not wag the dog. So you want to watch this because everyone will be sitting here staring at it going, well, I don't understand why we're going up. This is bad, recession, this, that. That's not why we're dropping. We're having really good earnings across the board. If you take a look at earnings, they're not bad at all for these companies. Oracle was really good, all-time highs. CRM, the issue is they're liquidating names because they're concerned about what's going on with the NASDAQ, and they know the underlying problem there. Does this mean you're going to miraculously just lift and everything's going to be rosy and we're all going to be high-fiving the bros again? No. But it does mean one of the issues that was weighing on the NASDAQ and was weighing on the bond market as well has completely gone away. So we don't have to worry about that. Now, what will that do? Well, it does a couple things, right? First and foremost, look what's happening to the bond market based upon that. You're at a 364, okay? So we're at the lowest 10-year that we've been, which is putting pressure on what? TLT, okay? So now you're watching TLT. The other one, because I keep hearing everybody yammer about this, so let's do it. So here's the 10-year on the yield, right? And so what you do is you take the US 10-year, and then you divide the US 10-year by the 2-year, and then you go and you click here, and then you divide it, right? And now what you're going to see, there we go. And what you're going to see is this inverted yield curve that everyone's been telling me we're going into a recession for the past 2 years, while they sat on the sidelines, why, tech basically doubled, but whatever. And now what you're going to see is you're going to see a great area here. What does that look like from here over, right? That's a breakout, okay? So now you're having this inverted yield curve invert. Now take a look at this. This is the 2 and the 10. So you're going to assume at the front end of the yield curve is going to do fine, right? You'd be correct. Look at IEF. It's actually mimicking what's going on there, okay? Left shoulder, head, right shoulder inverted. So you're probably, I know you guys don't get excited about this kind of stuff, but it's so easy. Like these trades, they're just so easy, it's silly. So you're heading back to this level, okay? And you can just go through all the names that we've been talking about and how they're running. Look at BTI breaking out all-time highs. So much so they're buying millions of their own stock back, millions of shares of their own stock back. MO, all right? So these kinds of names, and where's the money going? What was the number one sector that was up today? XLRA. Remember all those people that told you that commercial real estate was going to crash? Yeah, where are they now? So let's go through some of these names. WELL, does that look like it's going to crash? Maybe AMT, maybe they look like it. Nope. How about SLG? That doesn't look like it either. How about Vici? Nope. No, that doesn't look like it either. Okay, so what you're getting here is interest rate sensitive trades are working. So if they're working, and then you have the NASDAQ that doesn't have to worry about Bank of Japan, and yields are going to drop, okay, that means the equity risk premium, which we've gone over, which we'll go over again on Saturday for that video, that means the equity risk premium to the market is going to start favoring what? Equities. Okay, so if that starts happening, then what? Then we have the macro leg again. We have the fundamental leg again. See how this is all connected, right? Instead of just staring at a chart and waiting for your guru on Twitter to tell you something. And then all you do is, now that you know it's connected, all you have to do is go there and click that right there. And now look at these breaks. Okay. These are the simplest trades in the world. It doesn't really get any easier than these kinds of trades, okay? I would prefer to buy these at book value. I would also prefer if Giselle calls me back, but neither seems to be happening, right? Book value is like 24 bucks. So what we need to do with something like this, okay, very simple, is just you either get involved with this one or you don't. But when you start seeing these multi-year breakouts of these kinds of levels, and people want to talk about, oh, we're going into recession and we need to get out of these names and New York real estate's going to go to zero. None of this looks to me like it's going to zero. So you have this entire trade that's wrapping itself like in a perfect bow going into CPI, which everybody's worried about tomorrow because they're worried about the NASDAQ, which they should be. Because if CPI is really weak, then we could get hit. And this is really important. Just because we're through one threat does not mean we're through all the threats. And that's a very important distinction. All we're doing is clicking boxes. Bank of Japan's not an issue anymore. See, you're going through these levels of certainty. When you decide those levels, that's where it gets interesting. We are like a cat on a hot tin roof right now, and that is still a saying. The kids told me they say that. For example, when Ally comes out and says, by the way, yeah, we're seeing the consumer struggle a little bit, and they said it at a conference, yeah, that didn't go over real well. So as soon as they said that, you went from 39, you opened at 35, no note anywhere. People didn't even know that it happened. We knew it happened. You could see it drop and fall off a cliff. But here's what's even more important. Watch what it did to the rest of the market. Look at JP Morgan. JP Morgan down. Look how much you're down on JP Morgan on this Ally note. Now, there's another reason why it's down. Diamond stated his succession plan, and it's about 3 years out before he will retire. 8% today on JP Morgan. Watch Goldman and look at these moves. Okay, so does this look like it's the end, right, or the beginning? I talked about this a little bit, that they come for the generals last, and the last sector to fall is XLF out of this correction. It is starting to crack. Is that going to be just a day? I don't have an answer to that. I did see KRE come in. Top end names came down today, guys, like the top names, which is like FCNCA, Record earnings, record revenue, quarter over quarter, ever since they got to pick what assets they wanted to buy back here, right? You're up almost 100% in a regional in a year and a half. Remember, we're going to lose all the regionals again. Make sure you do your own homework, guys. So if you start looking at this stuff, XLRE, you start looking at KRE, how that came in today, how that's starting to bounce, it makes you think that maybe you should be looking at the home builders again and saying, okay, well, are they dead? We don't have an answer to that yet. Are they going to be able to buy more homes? We don't know. How bad is the consumer? We don't really know. We truly don't have an answer to that. What do we know? This is what we do know. We know that rates are going to come down. And if rates come down, then corporate bonds are going to go up and government bonds are going to go up. That's what we know. So whether you're buying the high yield stuff or you're buying the corporate investment grade stuff, or you're going to buy the short end or the medium end, right, of the bond market in an ETF, or they're going to buy the tail that wags right here, right, the long end, doesn't really matter. You just pick whatever area you want to be based upon how much risk you're willing to take. And these are very simple trades. So are all those REITs that everyone said we're going to go to zero because no one's ever going to go to an office again. When you start to look at that kind of stuff, that's what you're focused on. Now for tomorrow, we have to deal with the Qs and what's going to happen there, right? What is going to happen? Not a clue. I have a belief, I have an understanding of what I think is going to happen, and I'm going to get into it, but I think there's some really important things here to go over. For example, you look at the stocks today, okay? You held. We can say whatever we want. We held. I would rather have had an undercut, quite frankly. We did hold today. How about the volume? I mean, it's not great. You went up on extremely light volume. You're not even half of my moving average. So just always, I do things like this, so I'll explain it, what I do, because I think you're going to be curious. So I take my moving average, I go here, and I just drop a measurement to it. Okay, and then you can kind of see where you're normally at, right? You can see that right there, 459. I'm at 2.4. So what am I shy? About 2 to even be average over the past 55 days or 50 days? Yeah, I mean, I'm way off going into this. So am I happy? I've been happier, but I think what you have to do is say, this is the hand that we're dealt. We have to go from there. I think if you look at names like, the IGV space and now in some of these names, yeah, they're hitting highs, but are they hitting highs with that emphatic umph? No, I think you're through one hurdle. And if I was short most tech, which I did have some shorts on today that I did cover, being candid, I think you have to look at this and go, okay, what exactly are we doing? In other words, do I really want to be short going into CPI? I think there's certain names that sold off and look absolutely disastrous. And I'll give you an example of one. For example, Google. Watch at the end of the day. If you ever want to see what people really think of a name, watch from 3 o'clock on. Watch from that last hour. You can always just drop a demarcation line from the last hour. It'll tell you exactly what institutions are really doing with a name. They couldn't get out fast enough. The last 10 minutes are the market and close orders. And when you see this, right, and you can see how that's going, look at this. It's an absolute disaster, right? And this is the kind of stuff that we're saying. The other thing that we're seeing a lot of is we're seeing this kind of secondary market kind of thing where even PLTR, they went in the open market, they're deciding to take advantage of it, and they're doing secondaries, things like that. Some secondaries are holding up better than others. All right, so you have that whole side of the trade, right? You can look at Apple, and I don't think Apple is the one really to look at here because I think that was a dumpster fire of a conference yesterday. No confidence in them in executing this plan. Selling a phone before they even have the software ready with the upgrades is just absolutely baffling for the world's largest company, or one of the world's largest companies. What we have to deal with is what's going to happen with CPI tomorrow. That is really the crux of what we're dealing with. So let's take a look. So the first thing tonight that we have the debate. And we all know that the debate is going to be highly watched and is going to affect the market tomorrow. And if we don't know that, you now do. Who's going to win? Who's going to lose? We don't know. What we do know is that it's closer than it was before, and therefore it will affect certain names tomorrow. What we really need to focus on after that is going to be CPI. And there's a couple things here that I think that we should really pay attention to. Number one that we should be paying attention to is month over month. Now this is without core, energy and food. Okay, point two, point three. That's their forecast. This is consensus. This is where we were last time. So what they are saying, we're going to go through what JP Morgan is saying, and we're going to go through what's happened in the past. What they are saying right here very, very clearly is that you are coming in line. You're coming in line again. Core inflation, food and energy, you're coming in line. Inflation month over month up, we're going to come in line again. Consensus is 2.6, and then we're at 2.9. Okay, so year over year, we're going to come in at 2.6. Now, in front of us, is what happened last time. And last time we had a negative number. Now you'll see why I'm pointing this out. So this is where we went negative. It was July 11th and all heck broke loose, and this is where you're at. Really important to get. We did not have a number that negative, not once, since the pandemic. Now the best thing I can do is take a clip from one of the investment banks and walk you through how they say it. And I think that this is very helpful. We estimate the CPI rose 0.2 in August, okay? So we just went through the estimates. They're saying we're coming in line. Similar to its pace of increase in July, which is also close to the cusp of rounding down to 0.1 and rounding up to 0.2. Energy prices are expected to have weighed on the headline last month, with fairly broad-based weakness across energy sectors, consumers leading to a decline in August. Okay, so we know energy prices are going to be down. Okay, and I think that's really important, and I don't think that they're really compensating for that in this statement. We'll get to that. Food prices run at same price. A year ago, we see the headline inflation cooling to 2.6, which would be the softest annual reading since March 2021. Okay, so 2.6 is really weak, okay? And that's good because that's what's supposed to happen. Now, the reason I'm pointing this out is because if we are under 2.6 and we are dropping faster than anticipated, this is where bad news or lower than expected could lead to another sell-off. Even though it's what's anticipated, if it's worse and it's going faster, it could be a problem. They need to thread the needle here and they need to make it perfect. Away from food and energy, we expect closely watch core to come in at 2.1. which would be the firmest print in 4 months. So what they're saying now is we expect the firmest print in 4 months, despite what you see going on in the market. And this is where it gets weird. If realized a year ago, core inflation would have held steady at 3.2 in August with the details for core. Shelter-related prices have been volatile in recent months, but we look for owner equivalent rent to return to their normal prior gradual cooling. Okay. We look for owner equivalent rent, which is roughly, if you take all the housing stuff, it's roughly 32% of the CPI, okay? If you take that into account, they're telling you that they expect the firmest print, but they're telling you that owner equivalent rent to return to their prior gradual cooling, where lodging prices are likely to have fallen again in August, okay? So lodging's falling, OER's cooling, but we're looking for the firmest print in 4 months. Okay, and we don't have food and energy in core. Let me get to the other part of it. Let me find it real quick. Sustained downtrend. We are likely to have fallen in all reversal, sustained downtrend. We are relatively firm reading on airfares, which should boost it. It's like 8% airfares. Medical prices should also rise in August after decline in services. We expect that to be short-lived. So if we take a look at this, then they talk about cars as well. Key component industry suggests vehicle prices post another sizable decline. So they're saying that core is going to be up just because of medical supplies. You know, it's not really just medical supplies or medical services that are up. And this is where it gets really interesting. Now, I pointed this out on the public today in the public pre-market video that we do that's live, and you probably want to attend tomorrow specifically because we will be live tomorrow. Now, as we're seeing this right in here, look at where we're at. This is drip. This is bear, okay? So we're watching crude plummet as we're watching a hurricane approach Louisiana and they're shutting down production. Does that make any sense to anybody? Okay, so what we're seeing is crude completely break down today. No one's talking about this. And there's a couple reasons for this. One big is China. And we don't get into that on Saturday. But you see this crack? Like, that's a crack. You haven't had a crack like that since 22, where you're closing under that. Maybe here we had a little bit, but we didn't even close there. So you see where you're closing? See how that's setting up? It's not great. And it's telling you oil's dropping. Oil only drops when things get worse, guys. So we have this news out of Ally, right, which is the new thing we have to concern ourselves with. Crude is plummeting. We want crude down because crude oil is 2/3 of GDP on the earnings side. So when you calculate GDP, no matter what it is, whether it's AI or anything, when you blend it all together to get the parts there, to get things done, to put the wheels in the machine, to make rubber, whatever it is, 2/3 of all GDP earnings, you always want to look at crude oil. It's really that simple, okay? It can affect it greatly. But when you come down, EPS is supposed to go up, but also at the same time, it makes you wonder what's going on out there as we're starting to crack. All right, so that's what's going on with crude, and crude's dropping. Now, if we take a look at the most simplest way to look at the world, and I did this a little bit yesterday, but I just want to point something out. If I go here and we just do the simplest of things again, and we're going to take an anchored VWAP to make this really simple. And we're going to go to July 1st. Let's go to June. All right, and that's going to get us a June number. Now, what's important about the June number? Let's clean this all up. I don't know why it popped twice. Shouldn't have done that. Should only have done the one. I got a little goofy with the button. There you go. And then what you want to do is go take a look at July. And then here's July right here. All right, and let's make sure, boom, perfect. Okay, June and July were roughly in the same spot. So if you go to June 1st, right here where we start, Okay, and then you come all the way to the 30th. You're going to see that that was the average price, okay, of oil. Then you have here July, and you follow July down to the 30th, and it's going to put you right around the average same price on crude oil. All right, now that's why it's doing it, because I'm getting goofy when I hit that button there. All right, so you know that we're in the same price here. I'm not getting rid of all that. I don't have time to edit this, so it is what it is. And I'm not putting out that meme. I don't even have time to get the meme. So there you are again. All right, now it got nuts. Now we don't have a choice. Now we have to clean it up. So we're going to go to August, and you're going to remember where that was before, and if not, I can't help you. But you see where you're at now? You are clearly down more, and maybe the easiest way to do this is to go back to July. Try not to laugh, and let's go to here, and you can see the differential between the two. So June and July were aligned. July and August are not aligned. You see the difference here? Okay, there is no way that you're going to tell me that pricing is not dropping on this stuff. So this becomes the same thing in my head. Are they going to inflate this number the same way they tried to inflate GDP? I don't have an answer to that, but crude is really weak. Now, if you go and do the same exact thing here, and you do it with gas as well, this is gasoline, just so we're clear. Gasoline's falling off a cliff, okay? No one's talking about this, and everyone's like, oh, good, gas prices are dropping. Well, why? Well, China's in a lot of trouble, right? That's the first thing. And that's the very first thing we should be talking about to get rid of this. It's turning into more of a nightmare than work with me, not against me. There we go. And all right, let's start here and clean all that off. Let's drop this down and let's go from here. And what we want to do is mark this level off so that you can say it right here. And we've broken, right? And then we're just going to do the same exact thing for July. And then we're going to go here for July 1st. Okay. See that cross? All right. So you're in the same exact spot roughly for those months. And then you're going to go to August. Okay. See the difference? It's impossible for this not to be lower than the previous numbers. I don't know how they're going to do it, but it seems to me that it's absolutely impossible for these numbers to not be lower considering the price in gas. And all you would have to do this is just very simply come here. And I know there's more to it than that. I know there's housing. I get it. There's rents. But I don't know anyone that's telling me that the rents have gone up dramatically. You have a 6% differential month over month in gasoline. How is that not going to be reflective in the number? And I don't know the answer to that, but this is something that I need to watch. So most important thing for us to remember again tomorrow, and the thing that I think I'm going to leave you with is, you're going to want to watch the 830 bar on the ES and see how it acts. The same way that we watched it every single time. If you watch the action on these bars, like we did on Friday with non-farm payrolls, okay, it's always that bar that denotes the move and it sets the range for the day. And I know people think it's not. It's not. Here's that 830 bar with non-farm payrolls, and we're going to get one of these tomorrow. So all the people that love trading their zero-dated options that aren't doing this, that gives you an edge on it. Now look at that move right here, and look at how you hit there after Waller spoke and said everything was going to be fine. No one believed him, by the way. And you can see how you broke here, and then how it popped, retest, couldn't stay over, and that became a place of interest. You will see the same exact thing tomorrow. That's it.